Today, we're joined by Michael Farr, who's the Chief Market Strategist for Hightower Advisors, an affiliate firm with ours, and we're really happy to have him here. Now, Michael is an author of 3 books, and he's also, one interesting fact, he's the longest serving contributor for CNBC. Is that correct? That's the in the world. We have to add in the world, which was a
in the
very
world. Well, that's sort of cheap because the U.S. operations for CNBC started first, and all the others are newer. But yes, I'm the longest serving one in the U.S., which makes me the longest serving. Sounds better in the world, doesn't it? Yeah,
It does,
or maybe
definitely.
it just makes me sound older. All this white hair doesn't help either.
But please send over your questions. Anyone who has questions, you can send them to info@rikoongroup.com, or you can reach out to any member of the team to ask your questions, and we've got a great presentation, and we'll try to answer as many of your questions as we can at the end. And thank you for joining us, and I'll pass it off to you, Michael.
Great. Kyle, thank you very much. Thank you to the Rikoon Group. What an important firm for Hightower Advisors, as part of Hightower Advisors. If we could have more firms like the Rikoon Group. I'll tell you a story about where I am, where I see things right now in terms of Washington and the economy, and where I think we're going and what I think it's going to mean for markets. We have certainly been through a difficult market in 2022. It was a tough year for stocks, and there wasn't anything that magically changed as we got to January 1st of 2023. A lot of the same forces are in place. I gave a speech last week at the University of Delaware with Pat Harker, who's president of the Philadelphia Federal Reserve Bank. This is a speech I've given for 12 years, the economic forecast with one of the different Fed presidents. I've known Pat Harker for a long time. At one point, he was president of the University of Delaware and hosted me at the president's home for dinner, and we got to know each other. It was very comfortable visiting with him. Pat Harker told me a couple of things about the Fed. He told the audience, and he told me a couple of more things off screen, which I will share with you today, some of his off-screen comments here with the Rikoon Group audience. One, Pat said, we hate to make the same mistake twice at the Federal Reserve. So the big mistake we've made before was backing off too early when we needed to tighten monetary policy. I think right now what you're going to see, Michael, is 3 more quarter-point hikes. We're going to get to 5.25, and we're going to stop, and we're going to stay there for a while. So a pause is in the offing. A pivot is not. I think we're going to see inflation get down to 3.5% this year, maybe 2.5% in 2024, and then 2% in 2025. Now, if they're looking to get to target in 2025, he said they may ease rates very late in the cycle so that they don't overdo it. If they see things moving too quickly towards target, or that they're really going to throw us into some sort of much deeper recession, but getting to target will have consequences. And Jay Powell has said that getting to target is more important than the consequence of recession. When you have seen an inversion of the 1-month Treasury to the 10-year Treasury before, that has predicted recession 100% of the time. So maybe this won't be the time. And by the way, there are calls for a mild recession. Well, I've done this for 35 years, folks. I have never seen a call for any recession that wasn't initially a call for a mild recession. They've all been, everyone I've ever heard predict it's been for, we think we're going to have a mild recession. Well, good. And then somewhere in the cycle, they go, oops. Before I get to my first slide, and I'm going to move through these quickly, as I tell this story, I'm going to ask that you turn off your political ears. I'm really not making political comments. When I say we need immigration, I'm not saying that as because I have a bias politically. I'm saying that when you look at GDP growth, it's a combination of addition in your growth in your workforce and growth in productivity. And if you don't have any growth in your population or your workforce, you've got a big problem and you can't grow your GDP. This is a problem. We need more workers. And I'm going to show you a slide here that shows we have a decline in workers, and we did it to ourselves. The population in the US is actually declining, and we'll talk about that. That's a little weird. China's upset about theirs. They've got a decline too. They engineered it themselves. So here we go. Inflation and the Fed's response to inflation have caused a rapid increase in interest rates. They're trying to kill demand. The market continues to suggest that the Fed will be successful. All expectations are, I've got slides to show you this, the Fed's tightening is likely to cause a recession. And the Fed's emphasis is on stopping inflation and not inflating the markets. So they don't care, is basically what that means. But they don't care about inflating the markets. They want to stop inflation. Markets are going to do what the markets are going to do. And despite a big pullback so far, stocks are not historically cheap. I'm going to show you why. And historically high profit margins, I believe, are overly optimistic. And I think that earnings estimates still argue for a defensive equity posture, focus on quality, and a major focus, Stephanie Link and I talk about this all the time, major focus on pricing power. US GDP adjusted for inflation, we had this big turn down, of course, and then we've bounced back, and we've bounced back nicely, and GDP was positive last year. Great. That's not a recession, folks. We did have a couple of quarters of contraction, but with unemployment where it was, that hasn't been it hasn't been declared a recession by the NBER, and until Niebuhr says it is, it's not. So gross domestic product actual without COVID, we're about 2% off. So the overall expansion of the U.S. economy is still in place and intact. How did it happen? It happened with massive stimulus, $12.5 trillion of stimulus and low interest rates. Look at that Fed's balance sheet. And by the way, that Fed's balance sheet that's supposed to be coming down, it's right around $8 trillion now. The Fed balance sheet is around $8 trillion. It hasn't come down since the end of November much at all. It's virtually the same. So all of this, we're going to be selling assets and everything. I don't know what they're doing behind the scenes, but they didn't do it for the past month or two. And what's happened with the Fed funds target? Boom, straight up. This has been the fastest rate increase for Fed funds in history. The difference is debt. We've seen a $16 trillion surge in debt. We have over $31 trillion in debt right now. And as you've heard, we've hit the debt ceiling that's authorized by Congress. And when you hit that limit, you can't issue more debt. So Janet Yellen can't issue additional debt to pay our bills. And yet the country spends $1 trillion more each year right now than it brings in tax receipts. So what if you spend $1 trillion more than you bring in? You have to raise it by debt. Debt's the only option, and she's hit the debt ceiling. She has nowhere to go to get it. And so now she's scraping together this pay period. Where can she take funds in order to service the debt? And Social Security, Medicare, payments to veterans, all of those sorts of things. She's scrambling now. And how do you figure out how long? Well, she can probably do that. Estimates are till summer. Early summer, late summer, we don't know yet. What we do know is that Kevin McCarthy says he's not negotiating, and President Joe Biden says he's not negotiating. In fact, nobody's negotiating. What they are all doing is going to the nearest microphone and explaining why the other side is wrong, why they're not going to bend, and why they're not going to negotiate. And I think this is really important. I think it's really critical, and I think it's very dangerous right now, because these folks in Congress went to 16 different votes before they confirmed McCarthy. We actually didn't have a Congress in place. The 117th Congress, adjourned, and the 118th Congress didn't come in. It actually wasn't seated. And without them being seated and without a Speaker of the House, the line of succession changed from the president to the vice president. Normally the Speaker of the House, there was no Speaker of the House. You go directly to the Senate, President pro tem of the Senate. They didn't care. So my message here, folks, through this lifelong Washingtonian here, observer, is they are willing to fight, damn the consequences. And this debt ceiling issue, I still think will be resolved, but there's about it's going to be about 60-40 in favor of resolving it, which means 40% chance they could default. These folks will fight over nothing, and it's gotten meaner. Okay, the fallout here with all of this debt will be enduring. And right now, this is right now, folks, we've seen this per capita federal debt grow at a 7.5% rate increase. That's basically what the S&P has done, almost the same. So the rate of increase since 2005 in the national debt has matched the S&P 500 return at 7.4%. And by the way, we now have $94,533 in debt for every man, woman, and child in this country. Yes, every one of your children and your grandchildren, according to the United States, has a debt bill of $94,533. Really? How about that? Okay. People who've had assets have done well because we've inflated them. We've shoved almost $11 trillion into a $21 or $22 trillion economy. GDP right now is $24 trillion, and the national debt's $31.5 trillion, somewhere in there. We have way more debt than GDP. Reinhardt and Rogoff did a study 10 years ago, and what they showed, and it was over 70 different economies in 200 years, and what they showed was anytime debt got to about 100% of GDP, the cost of interest payments on that debt got to be so high that you began to lose 1 full percentage point off of prospective GDP growth. You think about it in terms of your household. If your mortgage payment and credit card payments get to be so high, you don't have any money left to grow. You don't have any money left to save. You can't grow your business or anything else because you're too busy paying your debt. So, but assets have inflated. S&P 500's done really great, okay, over the last 10 years. And go back 10, 12 years, so has houses. This is a housing index, this Case-Shiller, 20 different cities, way up, great. Consumers' net worth has really, really expanded. So the top 1% is that bottom blue. The next 9% is the orange. You see the mustard color on top. That's the bottom 50% and how much they've grown their net worth. They haven't. So they haven't grown their net worth. They are seeing wage gains, but the wage gains they're seeing are not keeping up with the price increases that they're seeing out in the market, at the grocery store, at the gas pump, at real estate, in the medical offices, and in college tuitions. I'm going to show you that as we go forward. So the haves have expanded, the have-nots have not. And this is, again, I'm not making political commentary or social commentary, okay? But this leads to a certain level of disgruntled American who, by the way, has seen the savings rate fall. I'm going to show you that. And credit card bills go even higher. So we've spent already what we had in the bank. We've spent consumers beyond what we had in the bank on our credit card balances. Average credit card interest rate right now, 24%. 24%. I can't tell you what it does. I'm sure Kyle can tell you what it does to him whenever you stumble across someone who keeps a credit card balance and you know they're paying 18, 20, 24%. It's mind-boggling how harmful that is. But this is not good for a stable society to leave these many people behind. That let them eat cake thing, it did not work out well for Marie. I think we ought to pay attention. There's one factor that could spoil the investors' party, and it is the inflation threat. The Fed's taking it seriously. This massive stimulus was made possible by low inflation and low interest rates. Do you remember hearing about this thing called modern monetary theory? Oh, it was all the rage, wasn't it, 3-4 years ago? Modern monetary theory. I said it was bunk, utter nonsense. And those are the nicest words I have, not the real words I use to describe what I really thought of modern monetary theory. But modern monetary theory, which was embraced by like real economists that you've heard of before, is said that as long as interest rates stay low and near zero, you can have all the debt you want. So the debt's not a problem because we're just going to keep interest rates low. As long as the Federal Reserve keeps interest rates in the basement, the amount of debt doesn't matter. Really? Okay. The Fed assured us that economic slack would contain inflationary pressures. And look at that yellow line, and the unemployment rate that spiked up. And, you know, when you get 10% unemployment, you don't have to give anybody who works for you a raise. You've got 4 people willing to take that job. Hell, they'll work for less. They just need a job when you've got 10% unemployment. We don't have that anymore. We're at 3.5% unemployment now. We have a lot more people looking to hire workers than we do people looking for jobs. And in fact, I'm going to show you that gap's about 4.5 million. There are 4.5 million more jobs open than there are people looking for work. Capacity utilization, it's one of these economic things, but basically it says, if you and I have a factory that makes donuts, and we ran that factory 24/7 and had it staffed with workers 24 hours a day and ran the machines at 24 hours a day, that would be that factory working at capacity. So if you look there at 2020, when we were down at 65% capacity, that's shoot. We can turn it up, we can make more donuts, and we don't have to really have more employees, and we don't have to buy more equipment or invest in technology. You get up where we are now at 80% capacity, all of a sudden, things are tight. We have inelasticity of capacity, and it's going to cost more. It's going to cost more. Our employees have to cost more because we got to pay them more. So the Fed said that inflation was transitory. Pat Harker got mad at me. He said, I told you, Farr, last time we did this 3 years ago, I didn't believe in that transitory stuff. I was like, yes, Mr. President, you did. But the rest of the Fed said that they did. Base effects, supply chain, a lot of those things did pass, but it wasn't as transitory as they thought. Parts of it were. Take a look at this. Velocity of money was a part of the problem. Money's got to move to create activity. You also have to have money out there. So we had money, plenty. The Fed, when struck with any crisis, floods the system with cash. They increase liquidity everywhere. So 2020, they increased the system with cash, and it still didn't move. But look at the right-hand side of the line. Do you see that blue line turning up? Velocity of money is picking up while the money supply is turning down. All of a sudden, it's starting to move, and there's a lot less of it out there in the system. That's inflationary. Do you see that? Moving it around, buying and selling, purchasing, investing. Inflation surge wasn't just the inflation surge here was not just base effects or volatile food and energy prices. This is the CPI. This is also the PCE deflator. It's their Fed's measure. Look at the direction that those interest rates are moving in. We're at 2-year rates are these highest in decades. These are annualized rates. Inflation. Inflation data have begun to cool. That's awesome, but they're still high. See them, that they've rolled over. They're coming down. Everybody's really excited that inflation has peaked and it's coming down. And that's good. It's an important start, but they're still high, which means prices are not going down. Prices are just going up at a slower rate. And that slower rate is slower versus 2 or 3 months ago. It's not slow versus 2 or 3 years ago. So it's still elevated and significantly elevated. You see how much time it spent below 4% and was in that 2.5% Fed rate target going back to 1995. This is way high. Commodity prices have rolled over. They've come down. We've seen a lot of it come down. Grain and flour, copper, lumber and shipping on the right-hand side, you can see have come back down. Getting a container from China to the US has come back way down. Fed presided over the formation of a housing bubble. It really spiked. This is big, exuberance and housing prices. I live in Naples, Florida, and housing prices they tripled. It's been absurd. They're not selling right now, though. It's even gotten quiet there. Interest rates go to 6% or 7% on a mortgage, and that slows down too. Real house prices, all of them down. So this is contributing to soaring rents. Rents typically follow 12 months or so, says the Dallas Fed. the increase in housing prices. So rents have been going up. And the people who pay rents, by and large, are the people who also spend in the society. If I gave each of you today $10,000, what if I gave you $100,000 today? I'm going to give each of you $100,000 today. What are you going to do when you leave here today? I'm going to bet that most of you are not going to go out and buy a new flat screen TV. I'm going to bet that most of you are not going to rush out this afternoon and buy a new car. Why? Because you all have assets. And if you wanted a new car or a new TV, you'd already have it. No, you're going to take my $10,000 or $100,000 check and go straight to Schwab or Fidelity and deposit it. You see? So it's when you give the money to the people who don't have it that it gets spent, and that creates demand, and that creates economic growth. And it's precisely that demand that the Fed is trying to kill. They want to crush demand. They can't do anything about supply, so they've got to go after that. But a recession and inflation is going to hurt the folks who are most vulnerable at the lower end of the economy much more than it's going to hurt us. But these shelter costs and rents, they're big, and they take a big portion out of a person's budget. Rents have gone up 26% over the past 2 years. 26%. If you were paying, right, 26%, if you were paying $1,000 a month, you're now paying $1,260 a month. Keep moving. Rents may continue growing at an outside rate. We'll see. But there's a shortage of home building labor, and there was underbuilding after the great financial crisis. We just didn't add to that supply. We've had a decline in unemployment. We've had a rapid increases in wages. So demand is still out there, and the supply of homes isn't out there. And so without the supply and more demand and more folks feeling like they've got some more wages, it's big. Housing prices will likely experience a correction, says Farr, if mortgage rates stay high. But basically, how much do they have to come down? 15%. 15% to kind of get back down to rebalance the U.S. housing market. That's a big dip. It has to do with those red pink lines are showing by 2025, both in home prices and monthly payments as a share of income, which would include rents there too. They've got to come down. If you see that those have to come down, what does that mean in terms of economic contraction or expansion? Contraction, think economic contraction, think recession. When you see that the prices are coming down is good, but you can see that they're not where they need to be to hit any type of equilibrium. Labor participation rate, number of employed has fully rebounded going back to 2020. We've got as many people or more working now, but the workforce participation rate is still down, We're at about 158 million people, who are employed, and the workforce participation rate is still way down. There are 330 some odd million Americans, and about 153 million are employed.
While we're waiting for Michael, I'll step in and take that question from Sonia. The labor participation rate is the percentage of the available workforce that is actually working. So basically, it's the percentage of all Americans between the ages of, I believe it is 18 and 67. They may still measure 18 to 65, but the labor
participation, we got you.
Rate is effectively a measure of how much of the workforce is either working or looking for work. So, for instance, someone who has retired at 58 would not be, they are still included in the labor participation rate, but they're not counted as unemployed. A 21-year-old college student is not counted as unemployed, but they do still count in the labor participation rate. So that it gives you a different picture of what the labor market is.
Great, thank you, Harry. Thank you for stepping in. And we did have another question come in, and we'll probably talk a little bit more about this question at the very end. But there's a question on where do you invest your money during this difficult time. I think one of the things we'll talk about is the rise in interest rates, and it's dependent on each person's individual situation and where they should invest, but there's a lot of opportunity to produce steady and stable income with higher interest rates right now. And so we do see a real opportunity when times are tough. There's actually a place to put your money where you can continue earning if you don't want to go through the volatility of the market. If you want to kind of avoid that turbulence, there are a lot of opportunities to invest in safer and stable assets, particularly in the fixed income markets as an opportunity.
There's that deficiency. So where have all the workers gone? COVID, child employment benefits, skills mismatch, migration. Here are the missing U.S. immigrants. We've had 1.7 million fewer working age trend. This matters a lot. You can see the difference between the trend line there that would be at least at 40 million and 2 million immigrants, basically, or more. Okay. Wage growth has also accelerated, but it hasn't. That wage growth, as I mentioned before, hasn't kept up with the prices that consumers have to pay. CPI and average, and here's what you're seeing. The blue line is the wage growth. The orange line is the CPI, and it's not keeping up. There's a gap. So consumers who have felt like they have more in their pocket have gone out to spend, and they've spent down all their savings because they feel better about what's in their check, and they've spent on their credit cards, but they are running out of wallet. And in an economy that's driven almost 70% by consumer spending, you've got to have a healthy consumer, right? I mean, the job of the vice president is check on the health of the president every day. If you're an economist in the U.S., you better check on the health of the U.S. consumer. And I'm telling you, they're running out of wallet, and their credit card bills are high, and their expenses continue to go up for stuff that is non-discretionary, like medical care, child care. Average hourly waitings are up, but so's food, beverage, and housing costs up. If you want to buy a TV, it's cheaper. Good for you. Savings rates fallen, there's the chart, to almost all-time lows. There's no backup, you see. And look at household debt. I mean, household debt has just skyrocketed, much higher than it's ever been, 2022 there. Credit card debt, Peter Lynch says any eighth grader can read a chart. Is it going up or going down? Look at where it is and think, remember, 24% interest on those credit card balances. Makes me sick. Okay, inflation has been much more durable than expected. It's been both demand and supply. Both demand and supply have been affected. Public's expectations are still kind of tame for now, that the Fed is going to be able to get this back under control. We see this spike in the blue line, but it's going to be coming down as we look at 5-year expectations. Interest rates are up, right? Interest rates continue to stay high. The 10-year Treasury well above, much higher yield. 10-year Treasury, much higher yield than it had been, but it's still a much lower yield than the 2-year Treasury. 2-year Treasury is paying more than the 10-year Treasury, right? So 2-year yields are higher than 10-year yields now, and the 3-month yield much higher than the 10-year yield. That's a bad sign. Fearful of being behind the curve, the Fed has hit the gas as hard as they've ever hit it. And taken interest rates as high as they can, and they're still going higher. And the Fed appears, investors think the Fed's going to be able to contain this inflation growth. The implied forward funds rate as of December 22 is still up in that 4.5%, even though the Fed is saying we're going to go up to, we're still going to take that Fed funds rate up above 5. And then the inflation, 5-year inflation rate is already out there below 2%. So markets aren't panicking about this yet. That's really important. How did we get here? Well, you get these populist governments who say we're going to have tax cuts and spending increases. We're going to make everybody happy. And then the deficits rise. And then there's a surge in bond issuance by the Treasury. And then Treasury purchases by the Federal Reserve to keep the interest rates low. And when the interest rates are really low, because the Fed has been buying everything the Treasury can produce, it higher and contracts the credit spreads. And then you get this exacerbation of economic inequality where the top 10% is doing great. Top 20% is doing great. Bottom 50% is doing nothing. The bottom 50% starts raising hell at election time. And the government says, well, we'll cut taxes and increase spending. This is over because the Federal Reserve is stopping. They're not going to keep purchasing, and they're not keeping interest rates low. This cycle has been broken. It was never one that was going to be sustainable. So recession or not, I think money lines up on the yes side. Pandemic savings are depleted. Inflation has been rising faster than incomes. There's a negative wealth effect. Interest rates are going to stay up. And this economic inequality is a problem because the bottom half of the economic population is the half that does most of the spending. They get the money and they spend it. You guys get the money and you save it. Good for you. You've done the right thing in taking care and being healthy, responsible financial citizens. But U.S. consumers do something better than almost any other consumer in the world. And that is, if you give them $1, they'll spend it more reliably than anybody else. Tightening cycles typically precede recessions. You can see the blue lines when they go up. Look at 1970. The gray line is a recession. Look at it going into 75, how it goes up, or 80, and how it goes up again after that in early 80s. So it went up here coming into 07 and 08. It's up again. Are we going to see a recession? I think we will. Okay, but recessions are normal, right? Recessions are normal. They come and they pass. I got stopped in Home Depot a couple of weeks ago by somebody who recognized me from CNBC, and they were all upset and said they needed to talk to me. All I wanted to do was buy an electrical switch. Honest to God, I just needed a wall switch, and this guy had me cornered. And Mr. Farr, this, and I see you on CNBC, and I need you to tell me, people have me scared about recession, and should I raise more cash, and do I need to be more defensive? And I said, look, 2 years from now, Fred, I read his name badge, Fred, we'll stand here in aisle 7 at Home Depot, and what I'm going to tell you is this recession, if we have one, will have passed, and the Fed tightening cycle will be over. And U.S. markets and the economy will be in some stage of expansion again. So think as a long-term investor, don't let yourself get too much in a twist over what's going to happen over the next 6 or 8 months when, if you believe, as I do, that 2 years from now, we're going to stand here and be just fine again, okay? Let's not get too upset over the short term. Stephanie Link and I always say, with some trepidation and hesitation, turn off the televisions, right? I mean, they pay us and stuff, but turn off the TVs. Don't let yourself get too much frenzied over this. If you need more help, think about Warren Buffett. What do you think he's doing? Do you think he's really upset about this? He might not be happy, but I promise he's sitting there on all of his cash thinking about what he's going to buy. What's he going to buy? This is the Treasury inversion spread, and how often when it dips below that black line, we end up in recession. This is when we end up in recession. So all the signs are there. I'm not being a Cassandra. I'm just looking at the data. Recessions on average last about 10 months, and they're usually at least half over by the time one's declared. Markets go down during recessions. Typically about 30%. We saw this one decline 24%. It ended the year down 19% for the S&P 500. Could it go down further? Yes. Will it likely go down and have a lower low than we're seeing today? I think so. I think we're going to see an earnings contraction. Earnings typically have 2.2% inflation, so we ought to be able to do okay and get through this. But earnings typically decline 20% in a recession. What about stocks? We've had a good 10 years, folks. Really good, huh? NASDAQ, Dow, S&P, all of them up almost 10, 13%. Stocks have done well, excluding dividends. And stock prices have grown much faster than corporate earnings in the economy. So the economy's gone up as the orange line. The blue line is S&P 500 earnings. So look what stock prices have done. Way more. But I want you to think about GDP that's not going to be going up for a period. And those earnings that need to come down a little bit. S&P 500 is still not cheap. We're trading at 17 times earnings. The average is 16 times earnings. It's come way down. That's great on the next 12 months earnings. But 16 times is average, and things don't just stop at average when they come down. They go a little below. This is not a crisis. I mean, okay, markets go up, markets go down, economies expand and contract. This is all normal. The problem comes when, and the mistakes come when you panic about it, when you make an emotional decision about your investing. This is when, this is when you're really lucky to be a client at the Rikoon Group, really. This is when you talk to them. They remind you of your long-term investment discipline, your philosophy, and your goals. You work through it together. They've certainly been through this before, and they'll help you get through it too. I'm so proud to work with the Rikoon Group and the other Hightower firms. Valuations have come down. Earnings expectations have not come down. My right-hand chart here shows expectations for earnings for the S&P 500, still up over last year overall. Is the blue. They're expected still, even though they've come down, they're still supposed to grow. Earnings during a recession, this is what I'm showing you, typically fall around 20%. Earnings for the S&P 500. Look at this chart. They're still up for next year. 20%. Let them go down 10%. And we've still got a contraction. And remember, if those earnings come down, this price to earnings ratio looks a lot higher, right? Because the price to earnings ratio is how many times earnings, $1 in earnings time for a $10 stock means that it's 10 times earnings. The stock's $10, earnings of $1. If I bring that down 10% to 90 cents a share in earnings times 10 is $9. So stock prices, this is why stock prices will fall on fundamental reasons. If you go back and take a look at what recessions have done in the past, you get these declines, 20%. Some of them have been really big. I don't see a reason to expect really big here. The banking system is solid. There is plenty of liquidity in the market. Corporate America, I think, has had plenty of warning about this recession. It's been the most forecast recession. It might be the best reason for a recession not happening is that everybody thinks one's going to happen. So we could all be surprised. The only things on this stock that are up here are up in February of 21 and is now all the way down. And if you bought cannabis stocks, you really lost. I probably shouldn't say this down there. Sorry for all of those of you who might actually have cannabis stocks out there. I don't know personally. I'm probably shouldn't. Some of the state licenses. It's a speculative investment for me. I don't have any idea, but long term, I think the stuff is here to stay. So we'll see if it comes. But this is speculative stuff. So it's nothing I would advocate, and I'd never recommend it to a client. I'm sorry to the Rikoon Group who are now going to get calls about Farr telling them they should invest in pot. I'm not telling you that. Don't do that. Fundamentals matter again. Balance sheets, earnings, cash flow, pricing power. 10-year Tina is finally deceased. You have other options now where you can earn some money. 4.80 on the 6-month Treasury. 4.8% on the 6-month Treasury bill. Come on. And you don't pay state tax on that. That's pretty good depending on where your legal residence is. Profit margins falling back could be a risk to earnings. Why do profit margins come down? Profit margins come down because you've got to pay more for your employees and your interest expenses go up. Those two things eat into profits. They've been low for a really long time. They're coming down. I'm almost done, I promise. So will margins normalize going forward? Yeah, they'll normalize going forward. Certainly they will. And we'll see what happens and the effects on the markets. The FANG stocks that have driven, that's come down a little bit more in line. We're watching that. But we've also seen that the other 495 stocks in the S&P 500 have underperformed. So I like the idea of hitting them where they ain't. This is the 5 stocks. They've been up 13.8% since 2017. Look at the rest of the S&P, the other 495 stocks, 7.5%. There's opportunity out there for investors. And I think it's part of the very good counsel and advice you've been getting from Rikoon, right? That's why they're there. Money market assets are high, over almost $5 trillion in money market funds. What does that mean to Farr? It means that can actually buffer a decline in the markets, but it will not buffer a decline in the economy. For a decline in the economy to be buffered, consumers have money to have to be able to go out there and spend it on stuff to buffer and not have demand collapse. They don't have it. Investors have it, and I think they will buy the dips perhaps a little more aggressively. Time in the market, this is so important, time in the market is much more important than market timing. If we go way back over the last 20 years, back to 2001, if you were invested every day, you'd have a return of 7.5%. If you missed the top 10 days, you have 3.4%. Look, you lost half of your return, more than half. 0.1% if you miss the top 20 days. You think you're going to be in the right days and get that completely right? So what could kill our golden goose? Well, a lot of things could, I guess, but tax increases, the inflation surge, if they don't get it under control, I think they will, continued interest rate increases. The Fed's going to continue to increase interest rates. And Jeremy Siegel's argument is they've already raised it enough. You've got to watch and see the effects of these rate increases because it takes 12 to 18 months for a rate increase to actually show up in the data and to affect behavior. Jeremy Siegel might be right, but the Fed's not listening, and they are holding firm to this next 0.75 of a point. They were doing 0.75 of a point hikes. Now they're going to do another 0.75 of a point in 3 meetings. Maybe they won't get all the way there. I think they probably will. COVID mutations, complacency. Be careful of complacency and the political headline risk. This debt limit is an issue. And I'm telling you, when I talked to Pat Harker about it at the University of Delaware last week, he put his head back, he sighed, and he slapped himself in the forehead. When you get a Fed governor, a president of a Fed regional bank to slap himself in the forehead, you know that you've thrown the problem at him that they don't know what to do about. They're fighting it every way they can. The debt limit could make them change in some very different ways. There are opportunities out there. Rikoon Group's been talking to you about them and advising, but pricing power, and there are some really good things out there. And I think that you find companies with stable above average earnings growth and great balance sheets, solid cash flow generation, wide competitive moat. All of these things are important. And here's my take. I think we can see longer term earnings growth of 4 to 5%. We go through this contraction, and I think earnings are going to grow. The economy continues to expand. You get a dividend yield of 2%. You've got a 6 to 7% stock return. I will take that over the next 10 years, and it's not far off where we've been for the last 10 years. So don't lose hope. Never lose faith in America. This is a free capitalistic society where innovation is rewarded. We have a stable democratic government. We have a government. Okay, we got a government. Sorry, it's just hard to say right now. Strong contract and property laws. We have an educated workforce, inflation, interest rates still relatively low historically, and a more competitive corporate tax rate. I can't thank you enough for having me today. It's been a great honor to be part of this Rikoon Group presentation. I'm here to be contacted if I can be helpful to you, but basically call Kyle and call the folks at Rikoon, and they will find me. And if I can be helpful to you, I'd be delighted to. Kyle, thank you so much for having me. What a pleasure to be here with all of your wonderful clients.
Thank you, Michael. Thank you for joining us. And do we have a couple minutes for questions if you have time?
Whatever you like.
Great.
I'm honored to
We're
be here.
we're pushing close to the hour, but we've got a couple questions that came in. And as you know, the hot topic is the debt limit on the television these days. And so the question came in just wondering, what does it actually mean for stocks and bonds if we fail to make a deal on the debt limit?
Well, what we thought in 2011 when we did this was that interest rates would soar. The S&P 500, S&P rating service lowered the rating on the U.S. debt to AA+. I mean, that has just irritated the hell out of me for the last 12 years to think that Johnson & Johnson and Microsoft have a better debt rating than the United States government. I mean, there's something, I love Microsoft and Johnson & Johnson. There's not a comment on them, but come on, the United States government has a lower rating from S&P 500. Okay. And then what we saw in 2011 was interest rates actually went down after they avoided the default. They came right up to the line, and they played that game of chicken. They're going to do it again. They're going to play this game of chicken. These people are so much more dysfunctional than the people we had in 2011. And it was all that Tea Party stuff that was loud and angry. I don't think that it will last long. I think it will be quickly resolved. I think it will be more of a media headline crisis that will pass quickly. But this crowd in Washington seems to have no compunction against these sorts of theatrics without understanding the real consequence to the economy and to our country's credibility and its position as the world's reserve currency. You can't fool around with stuff like this. So I think there are consequences out there, and I think that we will see a good deal of volatility as we get closer to that debt limit.
Great. Thank you. Well, we're up against the hour. We had some more questions come in, but we'll make sure to follow up with everyone and get your questions answered. But again, Michael, we really want to thank you for joining us today, and thank everyone who took their time out of their day to join us on the webinar and watch as well. And it's really great to have you, and we look forward to talking again.
I'm sorry about my internet. Thank you, all the clients of Rikoon Group. You all are great. Hope I get to see you in person someday. Thanks. Bye.
Great. Thank you.